While the complex end of the Great Depression is not part of this course, the New Deal and the Second World War was two reasons the economic instability ended. After the Second World War, the major nations met at Bretton Woods, an area in New Hampshire, England, to discuss the economic system after the World War. Here, the nations signed the agreement that established the International Monetary Fund, the World Bank, and GATT. GATT, as you should know, means the General Agreement on Trade and Tariffs, a predecessor of the current World Trade Organization. These were established to avoid instability like that experienced during the interwar period, and so far has been successful. The current pandemic is probably the biggest threat to these arrangements since their establishment, as well as increased nationalist movements. It was also at this conference that they decided to foster internal stability with full employment and price stability as the main aim of macroeconomic policy. They also decided on the system of a fixed exchange rate to the dollar, the international currency, rather than to gold. The IMF was constructed to lend to countries with persistent balance of payments deficits and to approve devaluations of currencies. Loans were made from a fund paid for by members in gold and currencies. Each country had a quota which determines its contribution to the fund and the maximum amount it could borrow. Large loans were made conditional on the supervision of domestic policies, now known as austerity, and is called the IMF conditionality clause. This is also to ensure repayment of loans made by the IMF. Devaluations could occur if the IMF determined that the economy was experiencing a fundamental disequilibrium. In order to avoid sudden changes in the financial account that could possibly lead to a balance of payment crisis, and remembering the instability of the interwar period, countries in the Bretton Woods system often prevented flows of financial assets across countries. But they wanted to encourage the flows of goods and services, thinking that trade benefited all economies. Under a system of fixed exchange rate, all countries but the United States had ineffective monetary policy for internal balance. That is because all countries had to follow American policy due to exchange rates that are fixed to the dollar. The principal tool for internal balancing was therefore fiscal policy, taxes, and government purchases. The principal tool for external balances was the loans from the IMF, restrictions on financial asset flows, and infrequent changes to the exchange rate. There are two main reasons for the collapse of the Bretton Woods system. First, speculation about a devaluation of the dollar caused investors to buy large quantities of gold. Remember, gold is still considered a safe haven when there is economic or exchange rate uncertainty. Second, the speculation about devaluation of the dollar in terms of other currencies caused investors to buy large quantities of foreign currency assets. The Bretton Woods system ultimately collapsed in 1973 because central banks were unwilling to continue to buy overvalued dollar-denominated assets and sell undervalued foreign currency-dominated assets. In 1973, central banks thought they would temporarily stop trading on the foreign exchange market and would let exchange rates adjust to the supply and demand. They would then reimpose a fixed exchange rate soon. Do you remember what else happened in 1973 that shook global economic conditions? You were taught in second-year macroeconomics. After this withdrawal, a new system of fixed rate was started again. After this withdrawal, no new system of fixed exchange rates was started again. There are four main arguments for the case of floating exchange rate. That is the current international macroeconomic policy and international monetary system. First, it provides countries with monetary policy autonomy. That means countries can set their own interest rate as they see fit to help with both internal and external stability. There is symmetry in the system. In this system, no country is king of all, like the United States was under the Bretton Woods system or England was under the gold standard. All countries face the same problems. The exchange rate serves as an automatic stabilizer. This is due to the shift adjustments of the market-dominated exchange rate. The exchange rate market is one of the markets closest to the perfect markets taught in economic textbooks. Finally, these rapid changes and adjustments in the exchange rate market also meant fewer problems with large current account deficits and surpluses, giving countries external balance.